Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and we have a terrific program this morning. Brief announcements, just our normal SIG meetings are being held during the month, and our next main event will be Christine Benz in March, the second Saturday, and she's going to do two different presentations. So I'm going to turn the time over to Bill Jump, one of our board members, to introduce our speaker. Go ahead, Bill.
Good morning and welcome all. Happy New Year and best investing in 24. Let me introduce Nick Atkeson, one of the founding members and partner with Andrew Houghton of Delta Investment Management based in San Francisco. Nick and Andrew run a very good ship. They have a wealth of experience with a number of brokerages and ran a hedge fund in their past. They're both MBAs. They have an excellent staff, including Jackie Ann Patterson, who we had probably 5-6 years ago. They have a slot in Barron's, published weekly on Saturdays. They have a book that's really excellent that I would commend, Win by Not Losing. So recall, if you lose, take $100, if your stock goes down to 50 as a share price, you bought at 100, you got to double your money. Even though you lost 50%, you got to get to 100% gain at that level to recover. So I don't see Andrew on. Is Andrew on, Nick?
No, it's just me this morning.
Okay, well, I want to give him a shout out because he's a partner of yours and a key guy in the operation. And so it's Nick and Andrew Houghton that are the main men there. So please welcome Nick. And I want to back up one minute. They publish a weekly newsletter that is really outstanding. And you can go to Delta Investment Management, sign up. It's free and always on point and excellent regarding the economy and stocks. So without that, I'll turn it over to you, Nick, and thanks very much for coming.
Okay, thank you. Okay, so we're going to talk about sort of the uncertainty of the markets and how the major predictions about what's going to happen in the market have been basically wrong for the last 5 years, but finding ways to make money in that kind of environment. So here's some disclosures. Basically what we're doing is we're not making any specific recommendations. The truth is that this presentation today is very applied. I mean, I'll be giving you lots of specific tickers, which you can buy and sell if you like. Basically, Delta's philosophy is there are times in the market to be heavily invested when the market appears to be bullish, and there are times to be reducing exposures when there are reasons to think the market's bearish. One of the difficulties of the last 5 years is determining whether we're in a bullish or bearish environment has not been easy. Many of the major macro indicators are sort of off out of whack, and we'll get into that. As Bill mentioned, we wrote a book called Win by Not Losing. It's available on Amazon. It's a little out of date. It's 2013, but it has some funny stories. It talks about sort of human beings that we've interacted with throughout the career, and then that's separated by commentary about how to manage money. As Bill mentioned, Barron's asked that we publish our Delta Market Sentiment Indicator in their Barron's weekly newspaper, and they've been doing that for years. We run one of our strategies is based on this being the indicator. It's a stock momentum measurement. So that if you like stock momentum trend following systems, that's what that is. As again, Bill mentioned, we published something called Delta Insights. It's a Friday morning email to you. And it's the great things about it is it's short. It's, to the point. It's got a cartoon. It gives you the Delta Market Sentiment Indicator if you want that. So it has, it's easy and understandable. It's not hard to read. I'll also say that if you decide you don't want to keep reading it, you would just tell us to stop and you could unsubscribe. We don't do anything with the data, by the way. So the way you get it specifically is it says info@delta.im. If you just email info@delta.im and say, please put me on your weekly newsletter subscription list, we'll do it. Okay, so predicting an event is one thing and benefiting from it is another thing. See, I'm a very bad predictor. I'm wrong most of the time, but it doesn't cost me much to be wrong. That's what matters. It's the payoff, not the frequency of being correct. So this is a mathematician, an options trader, talking about what sort of this idea of it's okay if you can't predict the market, you can still make money. All right, so here's the big picture. And I just, I don't think this is too much of a two-way conversation. So you just have to, I'll just rely on you to ask these questions and be truthful to yourselves. In 2020, when we had COVID and the market was down 35%, how many of you believe the market would end up 18.4%? Right? I don't think that was well forecast. In 2021, I think the feeling was there's going to be spillover effects from COVID. It hasn't played out fully, but the market was up 28.7%. And again, it's very explainable in hindsight, but with foresight, it's not. In 2022, things were supposed to be fine. Effectively, we had a recession. I know it wasn't declared a recession, but the market, the S&P was down 25%, the NASDAQ was down 36%. That's average for a recession. The market for the calendar year was down 18%. In my opinion, we had a recession. I'll provide a quick explanation of that in 1 minute. And in 2023, we had the most predicted recession in the history of America. We were going into recession in 2023. Earnings estimates for the S&P were like 175 to 200. The S&P, we'd be lucky if we got out at the end of the year with the S&P at 3,000, according to the consensus estimate. Instead, as we know, the market, it's not actually up 19%, it went up 26%. That's a little out of date. Just real quickly on 21 and 22. Basically, they shut down the in-person economy. You couldn't go to the store and buy things. So all sort of retail commercial activity went online. And technology companies, Amazon, et cetera, way overbuilt to accommodate this massive surge in demand. The fact that the entire economy moved online. And then in 2022, when the real economy stores reopened, a lot of people went back to buying offline. And the technology companies had overbuilt and essentially went into a recession. They had to cut back a lot. And because of their market cap sizes, they did a lot to drive the stock market. Okay. Why is everything out of whack? And I can give you a simple answer and we can all go home in 10 minutes, or we'll play through. But basically, we shut the economy down. We flooded the consumers with money. We constrained supply. And because we gave consumers money, there was high demand in a constrained supply situation. We had unprecedented inflation, unprecedented rate response from the Fed, and an impossible to predict stock market. It's interesting when you look back in history, a time that people forget about is at the end of World War II, all the soldiers came back and the economy wasn't set up to produce the things they wanted, the peace goods that they wanted. It was set to produce war goods. And a lot of people came back and started building their lives. And we had very, very high inflation. And in many ways, it was quite similar. Okay, so in response to shutting the economy down, the central bank flooded the world with money. We increased the money supply by 42%. By the way, they're doing a very good job of cutting back on the money supply, and you'll see that's a leading factor in inflation. So it looks like, the Federal Reserve and the reduction of money supply is going to be effective in getting our inflation where it should be. The fiscal response, and this is just a list of many things that the federal government did, but it was about $5 to $7 trillion shoved into the economy. So what happened? I mean, in COVID, here's 2020 COVID, there's that, if you can call it a COVID recession, but look at household net worth. It went to an all-time high. And actually, I put this little R2 there because in 2022, it came back down. And then we went ripping up again. And so my personal view is, and I'll show you from a market standpoint, effectively, we did have a recession. The only reason why it matters whether we had a recession or not is the market behaves a certain way when you're in a recession, and when you're not in a recession, it behaves a different way. And usually after a recession, you have a recovery. And many people would like think, it's odd to think about the market today in a state of recovery. It seems like we're on the verge of going into recession. We're in the early days of recovery. It's completely opposite. Okay. This is more households sitting on more cash than ever. And a lot of the cash is in, money market funds, but also just checking accounts. And money in checking accounts will get spent. And here's monthly retail sales. So 2020 way down, and just retail sales are just booming. So it's unlikely that we're going to get a recession when 70% of the economy is expanding. This is corporate profits after tax. I'm just showing that they boomed. Again, this makes much of the market's advance in the last 4 or 5 years more understandable. Pushing a ton of money into households, having them spend wildly, and corporate profits ripping up. There it is. Okay. Much of what's just happened feels, I don't know what you'd call it, artificial. It's not normal. It's not every day that we shut the economy down and tell people they can't leave their homes or can't go to the store or whatever. It's not every day that we bail everyone out with tons of free money. So it's not, it's not clear what the hangover is of doing these things. The big thing is, from the way we look at it, is, are we going into recession or not? And the reason why we care about going into recession is because the stock market behaves very differently during recessions, and not much else matters from a forecasting standpoint. So if you're accurately predicting recessions, you pretty much have a very good game plan for how to deploy your money and how to behave. Okay. Here's what happens in recession. And I think you've all seen this chart before. This is a chart where the gray bars are calendar year returns of the S&P 500, not including dividends. And the red circled years are ones where there was a recession. Well, you can see that if you just own the market in all the periods when there wasn't a recession, you did very, very well. Very small, in the worst case, very tiny drawdowns, -2, -1. The red numbers below here are intra-year drawdowns. The point being, every single year, whether it's a recession or not, the market does have pullbacks. Not surprising. But in recession years, the pullbacks tend to be large, 30%, 34%, versus sort of 7%, 11%, 3%, 7%, 5%. So you can see that non-recessionary periods, if you could just have your money fully invested in equities in non-recessionary periods and then reduce exposure in recessionary periods, you do well. Same is true with the 60-40 portfolio. Same thing. And by the way, bonds had their absolute worst year in 2022. So that really exacerbated the problem. All right. This is a very long-term picture of the market. And there are two things to take away from this. This is from 1900 to now. The first is that these negative periods are very concentrated. 2008, terrible time. 2000 to 2002, terrible time. Okay, so very concentrated periods of pain. If you asked yourself, outside of recessionary periods, what were the worst years in the market? It was 1957 down 11%, 1966 down 11%. So if you could judge with confidence that the economy really isn't going into recession or wasn't in a recession, and the market was down about 11%, the risk reward of investing is very good. Okay, so how do you predict a recession? And, it's talked a lot about, by a lot of investment banks, et cetera, et cetera. There are two indicators that have historically been very effective at predicting recessions: the U.S. Treasury yield curve and the leading economic index. So the Treasury yield curve, basically what I'm talking about is the 2-year and 10-year rates. When the 2-year Treasury rate is higher than the 10-year rate, meaning the yield curve is inverted, you then see a recession. And this chart is showing the blue line when it's above zero, the yield curve has positive slope. And when we go below this zero, the yield curve is inverted as a negative slope. And then subsequently you get your recession. Well, look at where we are now. The yield curve inverted in June of 2022. I have a slide for that. And here we are in 2024, and there's no recession. In fact, the market's doing quite well. So all of a sudden, first time, this doesn't work, or is, we just haven't been patient enough, and the beating is yet to come. All right. Since its inception in the 1960s, the leading economic index, that's the LEI, has neither failed to signal an eventual recession, a type 2 error, nor suggested that there would be a recession that never came, a type 1 error. It is a perfect 8 for 8. Okay, here's the leading economic index. You can see through time when it turns negative, and we use the 6-month moving average to make that determination, you get your recession. And that's these red bars. It's turning negative. Whoops, sorry. It's turning negative, recession, turning negative. Look at this separation now. Very, very, very negative. Yet GDP is actually growing. GDP is rising. And again, this went negative in the middle of 2022. It's been a long time, and there's really no real sign right now of much of a slowdown in GDP. So again, is the signal broken, or is there something else to explain it? Again, a simple answer is, well, hey, when you load households up with a ton of money and it's still there, maybe this stuff doesn't work because people have too much money and they like spending it. Okay, I'm just showing this chart. This is a leading economic index by month. This is change over, month over month change. It's just been constantly negative for almost 2 years. And this is the yield curve breaking down. I gave you both the 2-year and 10-year. That broke down in July. The 3-month and 10-year, the Fed likes to use that 3-month and 10-year. That broke down in October 2022. Okay, here's a picture of the market in 2022. 2022 starts, Russia invades Ukraine, that pops inflation higher. The market collapses down. The S&P at this point is down about 20% so. The LEIs inverts. The yield curve inverts. In October, the market actually sinks to the real low. But since then, all the market's done has gone up. Okay, so at this point, just in real life, in our own money management practice, we had to say, well, the signals are out of whack. They went off, they signaled it, but they signaled it at the same time that the market's already been hurt. So they're not being predictive at this point. They're basically coincidental, which for managing money is a little late. I mean, if you are already down, the damage is done. Becoming even more defensive is wrong. So, and now we'll get into like things you can do. Like right at that time in the history of the world, defined outcome ETFs with a downside buffer but upside participation made a ton of sense because the signals were saying things are going to get worse. But it seemed like if you looked at the average recession, it should get better. Clearly, the signals weren't firing in the right way, but there were instruments you could buy in the market that are new in the stock market as of the last 1 to 5 years that allow for you to invest in that kind of situation. All right, so I just want to show how wrong we've been when I say we, the bond market, professional investors, in the Federal Reserve in thinking about interest rates. So this is the Federal Reserve Fed funds forecast as of December 21. And you see they had a high of 1.6 here. And the absolute high over time would be 2.1. That's not that long ago. That's December 2021. Anyway, so inflation basically boomed up higher and lasted longer than people expected. And it hit a peak in June of 2022 of 9.1. And so in this rate cycle, the Fed did this. It took rates from basically 0 to a range of 5.25 to 5.5. And you can see because this curve is very steep, they did it at the fastest pace ever in the history of the world. And again, this is how the market kept getting messed up. In August 2, 2022, the expectation was the Fed funds rate would peak at about 3.4. A month later, it would peak at 3.7. A month later, it would peak at 4.4. A month later, it's going to peak. I mean, that's ridiculous. That's every month they're having to revise higher by meaningful amounts their expectations. This is a picture of GDP. Here's another little thing. So 2 quarters of down GDP, just rule of thumb, mean recession. We had that in the first quarter and second quarter of 2022. Okay, so that was big tech cutting back because big tech was booming in the fourth quarter of 2021. That's very high GDP because of all the movement to online everything. As of November 1, 2022, these are the earnings forecasts for the S&P. Like I say, the expectation, we had institutional, strategists say, essentially it was 100% the market was going to get crushed. Anyway, this is a chart showing recession probabilities have tumbled across asset classes. So recession gets priced into stocks, high-grade credit, high-yield credit, and treasuries. And it went from a very high level and it's pulled way, way, way back. Okay, so one thing I'll just say. When the world was certain we were going to have recession, you might have just said, hey, what happens if we don't? Well, we learned what happens if you don't. The market goes up 26%. When the world is pretty comfortable that we're not going to have recession, you have to say, what happens when we do? And it could be bad. So I'm just pointing that out. I'll show you some things in a moment. All right, this is earnings estimates are rising. That's good. Okay. Now we're going to get into sort of the applied portion of this discussion. Feel free to ask questions anytime. Okay, so the S&P 500 index is an active rebalanced momentum portfolio. It is used universally as the benchmark, so it must be owned. Any decision to move away from the S&P 500 involves elevated risk in institutional investing. I just want to say this. People talk about the S&P 500, oh, it's a nice index, it gives you diversification. That's not true. What it is it's a large cap momentum portfolio. It turns out momentum is the most persistent factor in the market. So it being a large cap momentum portfolio is good. That's good. That means if you want to make money, that's good. If you want diversification, that's not good. But if you want to make money, that's good. The next thing about it is it's constantly being rebalanced. It's not static. So that's good too. The next thing is every professional investor at some level has to own it. That's good. That means there's buying pressure. The S&P 500 is just an unusual, it is a good index. It is, if when in doubt and you don't know what to buy some S&P 500s.
There
In
is
some
one
sense, you can ask
question.
yourself, if I like the results of the S&P 500 over the last 5, 10, 15, 20, 30 years, why don't I own it? You should own it. Okay.
There is a question in chat.
Yep.
Fed increasing the target slowly in 2022 may sound like a broken record, but did it help controlling the bond market in check? But did it help controlling the bond market?
For the bond market, it destroyed the value of bonds. The Barclays Agg at one point was down 16%. The big thing it did that was effective was it actually really helped curb potential inflation. I think a lot of inflation would have dissipated anyway, but let's just take the housing market. By taking mortgage rates up to 7%, certainly slowed things down. The car market slowed that down. I think what it did is it's created a tremendous opportunity to buy bonds today. That matters. I'm not sure I'm addressing the question exactly, but that's my answer for now.
Thank you.
Okay. Risk is measured as volatility. Over time, up and down volatility cancels out and you're left with a trend. Would you have been happy with S&P returns the past several decades? If so, buy it. Okay, so whoops, sorry. Our problem is time. Because of our time is limited, we cannot rely on time to resolve our downside risk potential. If you have time, get long. In bullish periods, the S&P 500 delivers double-digit annual returns. In bearish periods, average annual returns of low single digit. The blend of bullish and bearish returns over the past 100 years is where the 7 to 8% average annual return comes from. Bearish periods may last for at least a decade. All right. Okay, here's the S&P 1996 till now. And we're right up here. We hit a peak at the first day of 2021. We went down and we're back basically right where we started at the beginning of 2023. So the problem is the market's quite expensive. And the question is where do we go from here? Are we bullish or bearish? And, the yield curve is still inverted. The leading economic index is still persistently negative. This is a consensus forecast I picked up on January 9th. Consensus GDP forecast for growth in 2024 is 1.35%. The top-down EPS estimate for the S&P is 232 for fiscal 24, and a price target of 4833, or 2.9% higher than today's close. Bottom-up estimate is 243. So the S&P is trading at 20 times, and the expectation is there's really not much upside. The next thing is there's incredible concentration, right? The largest 5 companies are now 24% of the entire index of the S&P. Okay, so what is going on? Okay, so this is a chart of capital spending as a percent of GDP. And many of you people have been around since the beginning of Silicon Valley. I don't know if you remember, but in 1988, there was a question of whether Silicon Valley would continue to exist. We had a recession and it wasn't clear. Anyway, capital spending on technology, was a small portion of GDP for a long time. Today, relative to equipment and structures, it's the largest single component of GDP. The other thing about spending on information technology is it's not cyclical. It just generally rises. There are some small pullbacks, but you can see from the blue line here, it has much less volatility than spending on equipment and structures. So as it becomes a much bigger piece of the overall economy, and because it lacks a lot of cyclicality, the overall economy becomes less cyclical. And of course, the wealth gets concentrated in the biggest names in this area. I'm only pointing that out because if you instinctively go, wow, there's so much concentration in, Microsoft, Amazon, Google, whatever, I feel uncomfortable with that. There's my Google in the background. You may want to reconsider that and say, okay, it's not all bad. These are countries ranked by R&D spending. Anyway, you can see here that the U.S. is by far the big spender. The $879 billion spent in 2022 on research is more than the next 5 countries combined. So that helps explain why the big companies got so big. Now, what happens in the 12 months following high concentration in the stock market? Well, in the dot-com bubble, the equal weighted index did okay in the first year after the bubble burst. And the market cap weighted stocks were down 21.7. In the 2008 financial crisis, equal weighted index was up 43.8. The market cap weighted index was up 25.4. Equal weighted index 42.7, market cap up 31.2. This just suggests that, if we don't go into recession, there will be a broadening out of stock valuation, and it may not be a bad idea to at least own market cap weighted indexes where you're getting a larger proportion of the smaller companies, or maybe even a small cap index. And the best small cap ETF that we can find is symbol CALF, CAF, CALF, CAF. Okay. Are you with me? Okay, so what I'm saying is the predictions aren't good. The market's moving around. The leading economic index isn't working. The momentum indexes are fine, but they're short term, and they have nothing to do with recession, really. Is there something else out there that we can think about that might help us get a clue as to how we should be, whether we should be real excited about owning stocks or not? And one of them is the risk premium of the market. In other words, stocks are risky. If you're going to buy stocks over, zero risk assets, you should be paid a risk premium. And if the risk premium is, suitably large enough, you should be excited about owning stocks. But if the risk premium is very low or negative, you should not be interested in owning stocks. For example, in the year 2000, the risk premium became -1. In the year 2000, the market was down 9%. 2001, -3, down 11. 2002, down 22%. In 2007, the risk premium dropped to 0.4. In 2008, the market was down 37. In 2021, the risk premium dropped to -0.6. The market was down 18. We're starting 2023 with a -0.7 risk premium. Or that's the year, the end from the final numbers of 2020. Sorry, we're starting 2024 with that as the risk premium. Point being, I would say, if we just took everything else out and said, okay, we need to come to a final decision. Are we in a bullish period or a bearish? Are we in a potential recession or non-recession? This is a meaningfully negative indicator. That's not encouraging. All right. But on the other hand, so now we're, if you look at market performance since the last rate hike, which happened to be July of last year, generally it's up. So economy growing, rates coming down, earnings rising. Who cares what the valuation is? Stocks go up. That's what that says. In my opinion, that is a very uncertain outlook. You've got a lot of, old school reliable indicators telling you it's going to be bad. And you've got some history that says it might be good. Translation, if you ask me, I just tell you straight out, I don't know. It doesn't, but me knowing doesn't matter. Our job is we need to go make some money. All right. So what do we do? Okay, the 5-year forward average annual return of the Barclays Ag Bond Index has a 94% correlation with the starting yield to maturity. Here's what I'm saying. If you buy a bond or a bond fund that's paying you a 6% yield, your average annual return over the next 5 years would be roughly 6% with a 94% correlation. In other words, very high probability you're going to get about a 6% average annual return. Same if you bought a 7% bond or an 8% bond. Point is, there are 6% bonds and 7% bonds and 9% bonds. And that, in a world where we honestly have no feel for the market at this point, it's very pricey. If you don't want to buy at the high, don't buy at the high, meaning we're near a high. You don't have to buy now. Maybe you should be considering some bonds. So on this page, I'm suggesting Mint, PYLD, SYFFX. JP Morgan has one called JPIE. Capital Group has a Capital Group CGCB, which is Capital Group Core Bond. The problem with Mint, I'll just say this, is it's short duration. You want to kick durations out to anywhere from, let's say, 4 to 7 years, because let's say your bond's paying you 6% and yields fall, you'll get some principal pickup and you might make as much as 10% on your bond.
There is
Okay,
a question. At least in California, inflation does not seem tamed at all. Why would the Fed lower interest rates?
Okay, so inflation has fallen from nationwide 9.2 to about 3.2, something like that. Prices are high, right? But then the question is, where's the price going from here? In other words, high prices aren't going to come down. It's just they may not inflate much further. That's a possibility. Honestly, okay, fair enough. It's a possibility the Fed may not be done with rate hikes. It's highly likely they are, in this way. They stopped raising rates in July of last year, and at the last meeting they talked about 3 rate cuts. So that looks like, now again, does the Fed know what it's talking about? I don't know, not really. I mean, sometimes. So, but if you're a betting man, the expectation is 6 months from now, inflation will be, let's say, 2.8 or 2.5. And 6 months from now, we'll see at least one Fed rate cut.
Okay,
That's the idea.
Okay, there's a second question about the ticker symbol given for the small cap stocks. Was that CAF, C-A-L-F?
CALF, yes. That's for small cap value stocks. And if you compare that to, small cap last year did terribly. It was horrible. But CALF did beautifully. It was, and it seems to be one of the better small cap. But that's the play where I showed you these charts that said what happens to the market in a period of, after it's been very concentrated. It does seem to broaden out where you get better performance from not the largest stocks. And that's why I mentioned buying a market weighted index, which would be RSP, or maybe even small cap stocks, which are very cheap, CALF. By the way, more detail on small cap. Small cap is the Russell 2000, IWM. 40% of the Russell 2000 companies, 40% don't make any money. Okay, that's bad. So the small cap ETF CALF only buys companies that make money. That's a big difference. Companies that didn't make money, just like a lot of the things in the ARK ETF were absolutely hammered. All right.
Thank you. Thank you.
Okay. Right now, the symbol BIL, which is the 1 to 3 month Treasury bill, if you're just holding cash, put it into BIL. It makes 5.3%. It's as stable as cash. It's just a great place to hold cash. And if you're thinking, well, let's say the world gets annihilated, in other words, you go into a recession, really bad things happen, and I want dry powder to use to buy equities in a downturn, Bill's where you might store some. It's going to be very safe there. I like high yield municipal debt. It's federal tax free. I list 2 mutual funds, a Goldman Sachs high yield municipal debt and a Pioneer high yield municipal debt. Again, it's federal tax free and it's got attractive yields and it has very low correlation to the stock market. And it was absolutely obliterated in 2022. So it's trading off very, very deep lows. This is just showing relative yields coming out of high yield municipal debt and even AAA rated municipal debt relative to other instruments. Basically, municipal debt's paying well. And then it's talking about rainy day funds and municipalities up near 30-year highs. So it looks like credit risk is low. All right. We're going through an energy transition and we're trying to electrify everything. There are many, many issues that will make the implementation of that, let's say rocky. True electrification follows a rocky road. Meanwhile, we've sort of made production of fossil fuels a criminal enterprise. Translation, nobody's going to invest in it. It's not something inviting new investment. But like for instance, when Ukraine was invaded by Russia, the largest exporter of liquefied natural gas became the United States to support Europe with their natural gas needs. The United States, over a period of time, changed out a lot of coal-fired power plants with natural gas. 65% of the electricity of the United States is powered by natural gas, blah, blah, blah. Basically, we're going to be pumping natural gas forever or a long time. Anyway, Enterprise Product Resources, it's an MLP. I like it, 7.5% dividend. You put it in a taxable account because nothing gets taxed until all your principal gets paid back, which is about a 10-year period. And they keep raising the dividend by about 3.5% a year. So that's just a good yielding, solid deal. And it will move up and down as the price of oil moves up and down. But the reality is it's pretty solid. It's 30% owned by the family, and the family wants to get paid its dividend. Okay, then there are these ETFs where they own an index, whether it's the S&P 500, it's the NASDAQ, it's their own value index, it's it's a group of ETFs, whatever it may be, and then they write calls against it and they collect premium. All right, so easy ones to think of. SPYI, this one right here, is the S&P 500 with an 11% yield. JEPQ is the NASDAQ 100 with an 11% yield. The point being is if you're not really sure about the market, you could buy SPYI with an 11% yield over the next 12 months. If the market were down 11%, you'd actually be flat because you got paid it in interest or basically dividend, whatever you want to call the return of call premium. So, that provides some buffer. So the buy right ETFs can provide you some downside buffer in the form of the yield. Okay, and depending on which one you bought, this is 2023 results. JEPQ was up 36%, SPY up 18%. They will underperform because they're chopping your return into dividend and principal, right, or capital gain, and they're selling off some of the upside. So it's going to take away some of the upside, but it does give you the downside buffer of the call premium collected. Okay, then there are these straight up hedged equity ETFs and mutual funds. Again, I'm talking to you about a world where the market's at is very rich, 20 PE. The 30-year average PE is 16 and a half, 16 and a half. There are indicators saying that we are going to go into a recession. The risk premium of owning equities is negative. So seems like we want to be a little defensive. So here's a hedged equity, JP Morgan hedged equity. I'm only pointing this out, just recent history. 2022 was down 8%. Remember, the S&P was down 18. 2023 was up 16. I mean, if you look at that string of return, it's just say it's numbed, but it's an attractive numbing, right? To me, it looks good. And then this down here, it's a percentile rank. You can see it ranks well over 10 years, 5 years, 3 years. Anyway, so that's JP Morgan hedged equity. And they have an ETF now that's supposed to do the same thing, and that's called HELO, HELO. And then the most straightforward sort of downside protection programs are these buffered ETFs, whereby you buy one, like today is January, so we go buy something called the PJAN. And what this says is that over the next 12 months, the first 15% downside in the market, we lose nothing. So market down 10, we lose nothing. Market down 5, we lose nothing. Market down 15, we lose nothing. The first 14% of market appreciation. Now, if the market goes up 20%, we get 14. If the market goes up 50%, we get 14. If the market goes down 20%, we lose 5. Okay. And that's over a 12-month period. So that's, pretty clear cut. Now you can get deeper buffers. This is one UJAN offers 30% downside protection. Now you have to give up the first 5%, and then from 5% down to 35 down, you're protected. And for that, you get the first basically 13.8% upside. So that's deeper buffer.
Mhm.
Actually slightly less upside, but not much less. Okay. One of the problems with, let's say, a monthly buffered ETF is you buy, let's say we bought it in January, and then the market goes up 10%. So we're good. We went up 10%. But if the market were then to go down 10%, we'd go down with it, right back to where our buffer starts. So you go up 10. Now, if you're very clever, you could roll it, in the period you were up 10, you just say, okay, fine, I'll buy a new one. Maybe it's now April. So you buy April, and now you've pulled up your buffer and you've raised your cap. So that would be smart. And they're obviously Innovator ETFs, this is the provider of these things, is trying to automate that. But one way, sort of what they've done that it appears to be their best offering from a sort of a actively ongoing situation is an ETF which is called SFLR, SFLR, where they're constantly rolling a 10% put position to keep you protected. So in 2023, this thing was up 21.7%. And it doesn't make a difference when you buy it. And you want asymmetric downside versus upside. If the market goes down 100 and you go down 50, it's okay as long as when the market goes up 100, you catch 80 or something like that. In other words, your upside capture is way better than your downside capture. And that's what this thing is offering.
There's a question about how are the Innovator ETFs returns taxed?
How do they return tax?
How are the returns taxed? Income tax likely.
Okay, so when you put it all in a like SFLR, all the tax issues are contained within the ETF. You don't have to pay. They're not creating a tax problem like a mutual fund. If
So
you
unless-
buy like a P, say if I went out and I bought PGN and then I wanted to roll it, I'd have to pay the capital gains.
But there's only capital gains or loss. There's no distributions, correct?
No.
Thank you.
I mean, I say that with 90% certainty. I'm pretty sure there's no distribution, but I'm pretty sure. Let's just leave it at that. They're not yield plays. Okay. So we went to Innovator and, we were like, okay, we want a very robust portfolio that doesn't need to be traded. And, we'll work through all kinds of markets where nobody's getting their predictions right. The market's up, down, left side, right. Who knows? And so this first screen I'm showing you is just sort of a comparison of some of the things. EALT is another buffered ETF that has a rolling element to it. And it's showing you risk return ratio, max drawdown is on the bottom. It's not like there's no drawdown, just to be clear. Annualized return is shown here. So gives you a sense of what they do. But then we said, how do we combine these into a model to get the best returns? And we came up with this model of these three ETFs in these ratios, EALT, HELLO, and SFLR. And these were they did some back-tested stuff, and they came up with these numbers here. There's since inception, which started in 2013. There's a 3-year, a 5-year, and then there's a 2022 just to look at that. Anyway, so there it is. The use of the basic point is, in a market that's let's say you're thinking about new money here at this peak, what do you do? And to me, mid duration fixed income and buffered ETFs make a lot of sense.
There's a question. What are the management fees for the buffer funds? How can they make money if they have a buffer higher than their costs?
Okay, so the client's actually paying for the buffer by loss of upside and all that. In other words, not buying and selling options. But but you're right. The Innovator ETF embedded management fee is, I'm just going to say this, it's high, and I believe it's like, they range, whether it's Innovator or First Trust, they range from like 60, 70 basis points to 1.1%.
And that's coming from the upside buffer?
No, that's just what they're saying it cost. That's the fee they just slap on the assets.
Okay,
Yeah.
understand. Thank you.
Yeah, they're not cheap. But you could go buy a structured note, right? Like so there've been structured notes for a long time. You can buy them at Goldman Sachs or JP Morgan or whoever. And the problem with them is they have no liquidity. So you get into the structured note, and then you decide you want to get out of it, you're going to take at least a 6% haircut. So these are basically simple liquid ways to get into structured notes.
Thank you.
Other questions?
Nick, I have a question. Earlier, you showed a chart where you showed, I think, the growth of R&D spending versus structure spending versus equipment spending.
Yeah.
Would you mind maybe providing examples or definitions of what those categories are?
Yeah.
I think I saw the chart blow through quickly.
Oh, okay. Hold on. So basically, information technology spending is easy, right? We're running a business. We need a new computer. Or, we migrate off of servers and now we move into the cloud. Or, we upgrade our software. Or, We buy all new monitors. It just goes on and on, right? Or we add applications. Or we create a bigger technology stack. Whatever it is, we find new efficiencies and everything. Or we change our phones from whatever to Ring Central.
And that categorizes as equipment? Is that?
No, that's basically technology spending. We're just buying software. That's all
Okay.
software.
Oh, so you would put that in the IP and R&D spending?
Yeah. I mean, no, I should remove the hardware element. The hardware is, but most of that is just software. That's, you don't need a phone to run a Ring Central phone. It's internet based. It plays off your computer if you want, on and on. Okay. Structures. Goodyear Tire decides it's going to make more tires, so it builds a factory to do it. That's a structure. Equipment. I need more presses to stamp out more pieces of plastic. Just think old economy. I need more door panels. I need more whatever. I need more, Mattel toys. And historically, there would be a good time in the economy and people would build up their capacity, and it was very delayed coming online, and then they would start pumping this stuff out, and then for whatever reason there'd be a pullback, and then there'd be a deep trough. The difference between that and sort of IT spending is that they're creating new stuff to buy, whether it's CRM or just think of anything, that the cyclicality of it is kind of gone. Whether it's good times or bad times, the solution is buy more technology. Oh, we're going into recession. I need to fire people. I went to McDonald's in Lone Pine, California. They fired all the front house people, and they put in little kiosks. So a person walks in, just does their ordering on a kiosk, and there's now 3 people in the McDonald's instead of 7 or something. It's just the answer to all problems has been just buy more technology, and so it's not cyclical. It's secular growth. You think about old America, 1950s, very cyclical, boom and bust. Does
Got
that
it.
make sense?
Thank you. Yes, it absolutely does. Yep.
I mean, what's going to happen when information technology, it's just passing up as being the biggest guy. It's very powerful. It's a very powerful effect. And then you have to ask yourself, okay, the biggest companies in the world used to be things like Exxon and IBM. I don't know. Were those ever worth what Microsoft and Google should be worth? Or if I say the word Amazon, my Amazon will activate, but Amazon, okay, Amazon, be quiet.
That command is not supported for this stream.
Hold on. Amazon, stop. The point is, these companies are so dominant, they're such monopolies, they have such barriers to entry, they have such high profits. Is a 20 multiple unreasonable? I don't know. Maybe the whole nature, the value of these things should be is worthy. If you look at the margins, the stock market margins of the S&P 500, I don't have a chart of it, but have gone from high single digits to now 12-14%, but the big 5 companies or the big 10 companies, they're 21 to 24% margins. In other words, they're just way more profitable.
All right. Well, are there any more questions? Feel free to type it in the chat. Otherwise, we'll queue up Bill or Lynn to wrap us up.
That's Bill. I do have one question. Can you hear me?
Yep.
What is your most underappreciated tech company?
Kodak. No, I'm kidding. Well, let me answer it this way. I'm going to punt. So we have a guy, Tyler Hassan, who is our genius stock guy, and he runs something called the Blue Chip Portfolio. And he was up 31% last year. He's very, very good. And you know, you can call up Delta, and then Kyler will apply his strategy in your account, and we can even mix it with our, you know, we can blend it with ETFs and things like that. But anyway, he will buy stocks, and he does own the larger mega cap tech. But you know, his most recent buys have been like apartment buildings, MAA, some of the largest apartment REITs in the country. So where he's seeing value is really not in technology right now, but elsewhere.
Okay, thank you.
Okay, we've got several questions coming in.
Oh, okay.
Are there systematic risks building in the market which can lead to a 2008 type crisis or a 1987 type crash?
We had a COVID bubble, right? What I mean by that is when we shut down the mainline economy and everything had to go into technology, technology stocks ripped higher, and we had a COVID bubble. And that bubble did get washed out in 2022. You know, basically the NASDAQ lost 36% of its value. So that was one issue. The bubble that is, you know, okay, let's just take bubbles. Let's say 2000 was internet cell phone bubble. Okay, that knocked the market down, I don't know, 82% or something. 2008, we had basically a debt bubble. Everybody was way overextended, and it blew the market up. Today, you know, but we've seen other bubbles. We've seen bubbles in, let's say, clean energy. Clean energy went screaming for a while, and now it's been an absolute dud for 2 years. The current bubble is AI. You know, we saw crypto bubble, right? Crypto bubble's a bubble, AI is a bubble. So you're getting bubbles all the time, but I don't see an overwhelming bubble that has the power to do what 2008 did, because 2008 was an across the economy, across all sectors, liquidity problem, which made little things like having your line of credit withdrawn, even if you're Purdue chicken and making your payroll, impossible. So that was just a total wipeout. The AI bubble is fully underway, and who knows how far it goes. But when that kind of pops a little bit, that's not going to hurt the average person, I don't think.
Next question. Should we dampen the tech and the 7 companies by owning equal weighted index funds? What is the recommendation?
Okay. So if you already own, you know, Amazon, Google, whatever, or the S&P 500, keep owning it. But your next purchase, I would say, go ahead and make it the RSP, the equal weighted index. Or you know, in our own portfolios, we have you know, we made a 16% allocation to small cap about, you know, this week actually.
2 new messages. Okay. Yes, Sodden Barons. It's a momentum indicator. It got very high this time, 87.3%. How about small company value?
The thing in the Barron's is a measurement of equally weighted S&P 500 companies is their price momentum. And essentially it's what percent of them are trading above their 75-day moving average with some adjustments to make sure we take out whipsaw problems. And that's all that is. Basically, at its current level, it's saying the market's fairly overbought. I'll give you,
Okay.
you know, here's an example of, you know, the market whipping around in a way that was really hard to predict. Just last year in October, if you guys remember, the S&P declined by about 10%. And you could have said, wow, this feels bad. It's the beginning of the end. We're headed towards that recession. And then basically on November 1, it turned around and it ripped higher. Okay. The Delta Market Sentiment Indicator dropped to 12. When you see the Delta, now, I didn't say 10, I said 12. When the Delta Market Sentiment Indicator gets very low, and we actually care, well, our threshold is 10 and less, we basically go all in. Because in every case, the market then runs up at least 20% plus over the next 12 months. So it hit 12, and then the market ripped higher. And it was like a fastball pitch that slammed into the catcher's glove, thud, and we stood holding the bat, didn't even take a swing. Never saw that coming. Kind of embarrassing. But I'm only pointing it out to say to you, if you follow this Delta Market Sentiment Indicator, one thing it does really well is it predicts way oversold markets. And when it gets down, like even below 20, you should be itching, you know, like, oh, maybe I should put a little money in, 15, no more, 10 more. Okay, it can go below 10 and go, it's been as low as 3. You know, but if you just say to yourself, and also, by the way, when it goes down that low, expect high volatility. It's going to test your conviction. But I'm telling you, in every case, the market's up 20% more over the next 12 months.
The only other question I see was, how about small company value? Was
Okay,
that
so what I mentioned before was the Russell 2000. 40% of the Russell 2000 companies don't make money. So for that index, it's inflating the PE. The average small cap company that makes money, the PE is about 15. So the PE for small cap is actually sort of attractive. The problem is you have to find a way to buy it. And that's why we talk about the CALF.
I'm going to make a comment. This is Lynn Gillette. I read the newsletter that Delta sends out every week, and I get tons of things in the mail. It's one email that I read every week. So I'll just make that an endorsement. I think it's a very good comment on the market and what's going on.
Thank you.
Terrific presentation, Nick. We really appreciate your presenting to us. Interesting material and a very provocative slant on what's going on and what's happening. So thank you very much for presenting today.